Welcome to the deep dive. We're here to take that stack of articles and research you've been seeing and really pull out the knowledge you need to be well informed.
And today's mission is a big one.
It's a huge one. We're talking about protecting your purchasing power, building a financial foundation that can actually stand up to, well, the biggest financial threat we all face right now.
And that threat is inflation. It's
Correct.
that quiet financial anxiety you feel when you go to the store.
All right.
We spend so much energy trying to earn more money, but we almost never see the invisible tax that's just eating away at the money we already have.
I had that exact feeling the other day. I was just getting my regular coffee, a medium latte, and I swear I remember paying $5 for it just a couple of years ago.
And now,
Now it's $7.50. And that's not just, a small price creep. That's a constant erosion of value. It's why so many people feel like they're just running in place financially.
and the irony is almost everyone uses these core financial products, bank accounts, insurance, but these are the things people understand the least.
Mhm.
And that knowledge gap isn't just an inconvenience. I mean, it is genuinely expensive. If you don't get these fundamentals right, you are always exposed.
So our goal today is pretty clear. We are going to eliminate that exposure. First, we'll tackle the invisible enemy by optimizing how you hold your cash.
And then we'll get to the shield.
Exactly. The
Yeah.
shield, how smart insurance decisions can protect everything you're building from, a catastrophe. We want to make sure you're in control.
So let's start with the root of the problem. Inflation itself.
Okay.
At its core, it's just the general increase in prices, which means the purchasing power of your money, your dollar, goes down.
And it's important to remember this isn't an accident, right? This is part of the system.
It is. It's intentional. Central banks, they generally target around 2% annual inflation. They see it as a way to stimulate the economy.
So the loss of value is actually baked in, but the real damage isn't linear, is it? This is where it gets really interesting for anyone listening who thinks they can just wait out a temporary spike.
No, the damage is exponential. If inflation averages just 3% a year, your money loses half its purchasing power in about 24 years.
Half in 24 years.
Yes. So an item that costs $100 today, in 30 years, that same item will cost $242. That compounding is relentless. It's why just letting cash sit there is a guaranteed losing strategy.
Okay, so when we talk about that rate, that 3% or whatever it is, we always hear the official number, the CPI, the Consumer Price Index.
Right.
But I think a lot of us feel like our own personal inflation rate is way higher than what the government reports. Why does that official number sometimes feel a little suspect?
Well, it comes down to a couple of major changes in how they calculate it. And these changes, they tend to push the reported number lower.
Okay, like what?
The first one is something called substitution. So the model just assumes that if the price of, say, ground beef gets too high,
You'll just buy chicken instead.
exactly, you, the consumer, will switch to a cheaper alternative, like chicken.
Wait, so the government is basically assuming I'm just going to perpetually trade down my lifestyle because things I used to like are now unaffordable.
That's the logic. It minimizes the reported cost of maintaining your current standard of living.
Wow. Okay, and what's the second one?
The second is hedonic adjustments.
Hedonic. What does that mean?
It's a fancy term.
Mm.
But if a product improves in quality, like a computer gets faster or your phone's camera gets better, the CPI adjusts the price increase downward.
Oh, come on.
The argument is that even though you're paying more, you're getting more value for your money, so your cost goes up, but the official index says the inflationary impact is smaller.
That completely changes how we should view that official number. And looking back historically, the 1970s, that seems to hold a pretty big warning for us.
It absolutely does. The 70s just shattered the belief that you couldn't have high inflation and high unemployment at the same time.
That was stagflation, right?
That was stagflation. And when inflation peaked above 13%, fixed saving strategies were just devastated. People who thought they were being safe and responsible were losing 8% of their real purchasing power every single year.
So the big lesson is, if you just rely on a standard savings account, you become inflation's #1 victim.
Its primary victim.
And that leads us perfectly into the solutions. Because if inflation is at 3% and your cash is sitting in a traditional savings account that's paying, what, 0.01%?
If you're lucky.
Right. It's like 10 cents a year on $1,000. You are actively, consciously losing value.
You are. So we need to optimize that foundation immediately. The very first step is to move your accessible cash, especially your emergency fund, into a high-yield savings account.
And the sources we looked at show the difference is just huge.
It's night and day.
Traditional banks have all this overhead, right? The physical branches, so they keep rates low. But online banks, they don't have that cost. So right now, they can afford to pay 4 to 5% APY.
It's not complicated. It's just picking the right place, the right address for your cash.
Exactly.
Now, for cash that you know you won't need for, say, 2, 3, or even 5 years, you can lock in even better rates with certificates of deposit, or CDs.
But there's a catch with CDs, right? The penalty for pulling your money out early, liquidity is the problem.
That's the Achilles heel, which is why you need a smarter strategy than just dumping all your money into one long-term CD.
And that strategy is CD laddering.
That's where CD laddering comes in. Instead of one big 5-year CD, you might buy 5 smaller CDs that mature one after another.
A 1-year, a 2-year, a 3-year.
And so on. So every year, one of your CDs matures. That gives you access to your cash. It gives you liquidity. You can either use the money or, if you don't need it, roll it into a new 5-year CD at whatever the current highest rate is.
So you get the high long-term rates, but with annual access to your cash. That's brilliant.
It balances the return with the need for liquidity.
Okay, we also need to clear up some common confusion. People hear money market and think it's one thing, but there's a huge difference between money market accounts and money market funds.
This is an essential distinction. Money market accounts are bank products. They're FDIC insured, just like a savings account.
Safe.
Very safe. Money market funds, on the other hand, are investment products. They're mutual funds that invest in short-term debt. And while they are generally very safe, they're usually not FDIC insured.
So if you're prioritizing the absolute safety of your cash, you have to know that difference.
You must.
Okay. Now, let's talk about what might be the single best tax-advantaged account available today. A huge tool for fighting inflation. The Health Savings Account, or HSA.
The HSA. If you have a high-deductible health plan and you're eligible, it is the ultimate triple threat.
Triple threat how?
Okay, 1, your contributions are tax-deductible, so it lowers your taxable income right now. 2, the money inside grows completely tax-free. And 3, withdrawals for qualified medical expenses are also tax-free.
But the real kicker, the detail that turns it into this sort of stealth retirement account, is what happens later in life.
That's the magic of it. Once you hit 65, you can pull funds out for any reason, not just medical. You'll just pay ordinary income tax on it, just like a traditional 401k or IRA.
So it has incredible flexibility. It should be a priority for anyone who qualifies.
Absolutely. Max it out if you can.
Okay, so we've covered optimizing the cash foundation, but none of that really matters if one major catastrophe comes along and just wipes everything out. We need the shield.
Need the shield. So let's shift to insurance, which is really all about risk transfer.
And the fundamental idea here is to insure against things you absolutely cannot recover from on your own, right?
Yeah.
Not small stuff.
Exactly. Catastrophic loss, a massive lawsuit, a debilitating medical event. You don't use insurance for, routine dental cleanings.
And the sources are really clear on this. One of the biggest, most dangerous mistakes people make is carrying the bare minimum liability limits on their auto insurance. Why is that so risky?
It is the definition of penny wise and pound foolish. If you cause a serious accident and your state minimum coverage, let's say it's $25,000, gets used up instantly.
Which it would in a serious accident.
Instantly. You are then personally on the hook for everything else, the rest of the damages. Plaintiffs can and will go after your future income, your house, your savings, everything.
That is terrifying. So what's the affordable fix for this? The thing that protects people with assets or, a good income?
Umbrella insurance.
Okay.
It's an extra layer of liability protection that sits over your existing auto and homeowners policies. It usually starts at $1 million in extra coverage.
$1 million? That sounds expensive.
And that's the fascinating thing. It's remarkably affordable. You're usually looking at maybe $150 to $300 a year for that first $1 million in coverage.
Wow. Okay, so that's a must-have. Now, we often talk about life insurance, but the insurance you're statistically most likely to actually need is disability insurance.
No question. The risk is just so high. A 35-year-old has about a 1 in 4 chance of becoming disabled for 3 months or longer before they retire.
A 25% chance.
And disability is a double whammy.
Right.
Your income stops, but your expenses, especially the medical costs, they often go up. Protecting your ability to earn an income is arguably more important than insuring your car or your house.
And when you're looking at these policies, there's a key difference in the definitions that really matters. The whole own occupation versus any occupation thing.
This is critical. Own occupation is the one you want. It's more generous. It pays benefits if you can't perform the duties of your specific job.
So it's essential for a surgeon or an engineer or someone with a specialized skill.
Exactly. Any occupation only pays if you can't perform any job that you're suited for based on your education and experience. It's a much higher bar to clear. Own occupation protects your specific earning power.
Got it. And one quick thing on homeowners insurance. What's the practical difference between the standard HO3 policy and the broader HO5?
So an HO3 is the standard. It provides what's called open peril coverage for the house itself. So everything is covered unless it's specifically excluded.
Okay.
But it only provides named peril coverage for your personal property inside, your furniture, your electronics. So it only covers the specific risks listed in the policy. The HO5 is better because it gives you that open peril coverage for both the house and your stuff inside. It's just broader protection.
All right. We have optimized the foundation. We've built the shield. Let's pull this all together into some actionable strategies people can use to really defeat inflation long term.
Okay, first thing with insurance. Shop around. Do it religiously. Rates for the exact same coverage can vary dramatically between different companies, and please avoid the big mistake.
Which is using insurance for small claims.
Yes. Our sources show that filing small claims, especially on your homeowner's insurance, is often a bad move. The premium increases you'll see for the next 3 to 5 years can easily cost you more than the claim payout itself.
So save insurance for the big stuff, the true catastrophes.
Exactly. Now, for the long-term inflation fight, any money that's beyond your emergency fund, it has to be put to work in productive assets.
Like stocks.
Stocks offer great protection because companies can just raise their prices to protect their profit margins. They pass the inflationary cost on to you, the consumer.
And the sources also point to a really powerful, maybe misunderstood strategy, using fixed-rate debt when inflation is high.
This is the strategic borrower's advantage. If you have a fixed-rate mortgage, it gets easier and easier to pay off during inflation.
Because you're paying it back with money that's worth less.
You're paying back the loan with cheaper dollars, and if your salary goes up with inflation, that debt burden shrinks dramatically compared to your income. It actually turns debt into a wealth-building tool.
And finally, the most important investment of all is in yourself, your human capital.
That's it. Skills that are in high demand allow you to negotiate raises or change jobs to keep your income ahead of inflation. Don't let misplaced loyalty keep you in a job where your salary is effectively going down every single year.
And while you're doing all this, you've got to maximize those tax shelters we talked about. Your IRAs, your 401ks, and especially that HSA.
Locking in that tax-deferred or tax-free growth when inflation is high is it's just non-negotiable for building real wealth.
So we've covered the whole playbook. Securing your cash foundation, putting up the shield, and then actively investing to fight back.
Right. This deep dive really shows that financial security, it's a strategic process. It is not a passive thing that just happens.
You now have the knowledge to go beyond just earning money and start making your money work smarter for you. You can be inflation's victim, or you can use this knowledge to become its master.
And that leads to the final provocative thought for you to take away today. Inflation forces us to abandon this old belief that money is a static, safe store of value. It's not. You have to shift your mindset to see money as a dynamic tool. So here's the choice. Money sitting idle is guaranteed to lose value. Money invested in productive assets builds wealth. Which direction will you choose for your resources today?